Amidst the EBITDAs, NPATs, ratios, and accounting quirks, it's easy to forget that nothing beats cash.
It's like oxygen, it's there all the time, but if it disappears for a few minutes, it's all over.
In this video, we're going to explain why it's worth looking at companies based on their ability to generate cash. Free cash flow is the cash a company generates from its business operations after considering working capital needs and capital expenditure. Put more simply, if a company has positive free cash flow figure, it means that it's generating more cash than it needs to run and maintain the business. This cash surplus in the business is good news for shareholders. It can be used to pay dividends, invest in growth opportunities, pay off debt, or even buy back shares. So where does company earnings or net profit fit into the equation? Profit is often touted as the benchmark for a company's fundamental performance. It's the figure that's most often quoted in earnings season, and stock price performance often hinges on how much a company is earning. While cash is visible, tangible, and traceable back to physical bank accounts, a company's profit or its reported earnings are actually a byproduct of several assumptions and choices made by management. These assumptions will often span across various accounting policies. Earnings management is a term used to describe how a company can interpret and manipulate accounting principles to inflate or deflate their earnings. Earnings management may in some cases be considered prudent, where adjustments improve the reliability of financial information. For example, banks often record provisions for bad debts, which represent the expected amount of loans that will be defaulted on in future periods. When market conditions are poor, banks might increase their provisions in expectation of more defaults. While the end result is lower reported earnings for the banks, these adjustments improve the relevance and reliability of its financial statements. However, history has also provided us with countless examples where more aggressive displays of earnings management has led to misleading financial results. Let's dig a bit deeper. Perhaps the most prolific example and downfall of a company using earnings management for nefarious purposes was Enron. Enron was an energy supplier and trader that saw its peak in the 1990s. Enron's energy trading desk utilized an accounting method known as mark-to-market accounting. This method measures the fair value of assets and liabilities, rather than the cost of these assets and liabilities. Enron manipulated this accounting method to report inflated fair values of the company's assets. When the dot-com bubble burst in 2000, Enron managed to conceal huge unrealized losses. Enron also got into the habit of booking revenue for multi-year projects upfront, shifting profit tomorrow to profit today. The result, Enron appeared profitable, but in reality was harboring millions in cash losses. Enron filed for bankruptcy in 2001. Enron's demise provides a pivotal lesson in the shortcomings of reported profit and why relying solely on a company's earnings to form a basis for an investment decision may be insufficient. A focus on free cash flows doesn't just shield investors from the pitfalls of earnings management. Here are 3 key reasons why investors should be looking for businesses with strong cash flows. 1. Solvency and security. A growing concern for investors today is financial security. While investing in a portfolio of shares generally means higher expected returns relative to other asset classes, many investors struggle to stomach the risk of bankruptcy. Companies with high free cash flow generation are often highly solvent, giving investors greater peace of mind that the risk of a company collapse is less likely. 2. Best place for growth. Companies that can generate more extra cash flow are well equipped to participate in profitable growth opportunities. These can include new projects, acquisitions, and entering new geographies. 3. Self-sufficiency. Companies generating high free cash flow are less reliant on capital markets to access additional funding. This self-sufficiency point is vital in today's high interest rate environment. These companies are likely to be less reliant on debt markets and therefore less susceptible to interest rate risk. Additionally, these companies are less likely to issue new shares, which could dilute existing shareholders. Evidence also suggests that there's a strong association between companies that can generate high levels of free cash flow and their respective share market performance. Have a look at this chart. It illustrates how global companies with varying levels of free cash flow generation, being free cash flow over assets, have performed over the last 17 years. The largest companies across all developed share markets have been ranked by cash flow generation and split into 5 equally weighted portfolios. You'll notice the linear relationship across the different portfolios. Over the time period, higher performance was achieved by companies generating higher levels of free cash flow relative to companies generating low levels of free cash flow. If you're interested in getting exposure to companies with strong cash flows, check out our Global Cash Flow Kings ETF, ASX code CFLOW. CFLOW is designed to track the performance of 200 diversified companies that deliver strong free cash flow with relatively low levels of financial leverage. At a weighted average level, CFLOW's portfolio generates roughly twice as much free cash flow relative to assets than the broad global equity benchmark. Check out the fund page for more information.